In 2007, Warren Buffett sat down with a room full of his own staff. He asked them a question. He said, "How many of you paid a higher tax rate than I did last year?" Every single hand in the room went up. Warren Buffett, the third richest man on the planet at the time, was paying a lower percentage of his income in taxes than his receptionist. And here is the part that should make you stop scrolling. He was not cheating. He was not hiding money in some offshore account in the Cayman Islands, at least not in that story. He was not doing anything illegal. He followed every rule. He filed every form. He did everything the government asked him to do. And he still paid less than the woman answering his phones. That story made international headlines. Politicians debated it. Economists wrote papers about it. Obama referenced it when pushing for what he called the Buffett rule. And then nothing happened. The system stayed exactly the same. Because here is what most people never understood. It was not a bug. It was the design. The tax code was not broken. It was working perfectly. Just not for the people who built it with their paychecks. Today we are going to walk through exactly how this works. Not in theory. Not with charts that require a finance degree to decode. We are going to follow the money step by step from the moment someone earns $1 to the moment the government comes to collect. And we are going to show you why the rules are built so that the more you have, the less you owe. Stay with me here. There are roughly 2,700 billionaires on Earth as of 2024. Their combined wealth sits somewhere north of $13 trillion. Meanwhile, the average American worker pays somewhere between 22 and 32% of their income to federal taxes, state taxes, and payroll taxes before they ever touch a single dollar. But a report from ProPublica, using actual IRS data that was leaked in 2021, revealed that some of the wealthiest people in the country paid an effective federal tax rate close to zero. Not zero as in a small number. Zero as in nothing. Or a fraction of a percent. Jeff Bezos in 2007 paid zero federal income tax. Elon Musk in 2018 paid zero. George Soros went 3 straight years paying zero. Now your first instinct might be, okay, this must be tax evasion, right? The IRS must be building a case. Someone must be going to prison. No. The IRS audited these people. They found nothing wrong. Because there was nothing wrong. Every single dollar, or $0, was legal. So how does that happen? How does a man worth $200 billion pay less in taxes than a nurse in Ohio? The answer comes down to one thing. The type of income. Step 1. The two worlds of income. Here is the first thing they do not teach you in school. Not all money is treated equally by the tax code. When you go to work, when you trade your time for a salary or an hourly wage, the government calls that ordinary income. And ordinary income is taxed on a scale. The more you make, the higher your rate. In the United States, the top bracket sits at 37% on income above around $578,000. But even at modest salaries, most working Americans are paying somewhere between 22 and 24% in federal income tax alone. Stack on top of that Social Security at 6.2%, Medicare at 1.45%, and then your state taxes. In California, that can be another 9.3%. Add it all up and a middle-class worker in a high-tax state could be sending close to 40 cents of every dollar they earn straight to the government. Now, let us look at how a billionaire earns money. Most billionaires do not take a salary. Some of the most famous ones, Bezos, Zuckerberg, Larry Ellison, have famously paid themselves $1 a year in salary. That is not a humble gesture. That is a tax strategy. Instead of salary, their wealth grows through stock, through ownership, through what the tax code calls capital gains. In capital gains, the profit you make from selling an investment is taxed at a completely different rate. Long-term capital gains for assets held longer than 1 year are taxed at either 0, 15, or 20% depending on your income level. So right there, before we even get into the clever strategies, the richest investors in America pay a maximum of 20% on their biggest source of income. The average worker pays 37% on theirs. Plus payroll taxes that wealthy investors do not pay at all because payroll taxes only apply to wages. The system was not designed to treat everyone equally. It was designed to reward capital over labor, ownership over work, and it has been that way for a long time. Step 2, the loan trick. But here is where it gets genuinely strange. Because selling stock, even at the lower capital gains rate, still triggers a tax. And the ultra-wealthy have figured out how to avoid even that. The strategy is sometimes called buy, borrow, die. Here is how it works. Say you are Elon Musk and you hold $10 billion worth of Tesla stock. You do not sell the stock because selling triggers a taxable event. Instead, you walk into a bank, or in reality, a very private wealth management firm, and you use your stock as collateral for a loan. The bank lends you $1 billion in cash. You use that cash to live, to buy a house, a yacht, to fund a new company, whatever you want. Now here is the critical question. Is a loan taxable income? No, it is not. A loan is debt. Debt is not income. The IRS does not tax debt. So you just accessed $1 billion and you owe zero taxes on it. You make a low interest payment to the bank each year. That interest payment is, in many cases, also tax deductible. And you never sell the stock. You let it keep growing. When you die, and this is where the die part of buy, borrow, die comes in, your heirs inherit the stock at what is called a stepped-up cost basis, meaning the original purchase price is wiped out and reset to the value at the time of your death. The entire paper gain that accumulated over your lifetime disappears for tax purposes. Your heirs then sell the stock. They pay taxes only on the gains from the moment they inherited it, not from the beginning. Decades of appreciation. Gone. Tax-free. Passed down to the next generation. The loan gets repaid from the estate. And the cycle begins again. This is not a loophole in the sense that someone found a glitch in the code. This is the code working as intended for people who have enough wealth to use it. Step 3. Depreciation and the real estate illusion. Now let us talk about real estate, because this is where the absurdity gets almost comedic. The tax code contains a concept called depreciation. The idea is straightforward. Physical assets wear out over time. A machine in a factory loses value. A building gets older. And because it loses value, the tax code allows businesses to write off that gradual loss as an expense, a deduction against income. In theory, this makes sense. In practice, it has become one of the most powerful wealth-shielding tools in existence. Here is why. Real estate in the real world tends to go up in value over time, especially in major cities, especially over the last 20 years. A commercial building bought in 2003 in downtown Manhattan is almost certainly worth more today than it was then. But the tax code says you must depreciate a residential building over 27.5 years and a commercial building over 39 years. Every single year, you get to write off a portion of that building's value as a loss, even while the building is making you money, even while its market value is climbing. So you could own a building that generates $2 million in rental income per year, and after depreciation deductions, report a taxable income near zero, or even a loss. A loss that, in some cases, can be used to offset gains in other parts of your portfolio. Real estate developers understand this better than almost anyone. It is not an accident that some of the most famous wealthy Americans have built their empires in real estate. The tax code practically subsidizes it. And if you want to sell a property and avoid the capital gains, there is something called a 1031 exchange. You sell one property and roll all the proceeds into a new one. No taxes owed. You can chain these exchanges together for years, decades. You can die holding a chain of properties that have collectively appreciated by hundreds of millions of dollars and never once trigger a capital gains event. This is legal. This is documented. This is Tuesday in the world of real estate investment. The uncomfortable math. Now let us slow down and look at what this actually means when you run the numbers. ProPublica, in that 2021 report, introduced a concept they called the true tax rate. Not the official rate that the IRS tracks, but the actual percentage of wealth gained that went to the government. Between 2014 and 2018, Elon Musk's wealth grew by approximately $14 billion. His total taxes paid over that period were approximately $455 million. That sounds like a lot, until you realize it is about 3.27% of his wealth gain. In the same period, a teacher making $50,000 a year who got a modest raise paid closer to 28 to 30% of every new dollar earned. Same country, same government, same roads, same infrastructure. One person paid 3 cents on the dollar. One paid 30. And neither of them did anything wrong. The ProPublica report was condemned in Washington, not because the numbers were wrong, but because someone had leaked private IRS data to publish them. The response from much of the political establishment was not outrage about the tax rates. It was outrage about the leak. That tells you something about who runs the room. Contrast, the hype versus the reality. Now, every few years, someone in Washington proposes a solution. A billionaire tax. A wealth tax. The Buffett rule. Close the carried interest loophole. Tax unrealized gains. And every time the same thing happens. The proposals generate headlines. They generate debate. They generate think pieces and op-eds and viral social media arguments. And then they quietly disappear. Sometimes they die in committee. Sometimes they pass one chamber and stall in the other. Sometimes they get watered down into something cosmetic. The carried interest loophole, which allows hedge fund managers to pay capital gains rates on what is essentially their salary, has been targeted for elimination by nearly every administration since 2008. It is still there. A wealth tax was proposed. It went nowhere. The Build Back Better package included a provision to tax billionaires on unrealized gains. It was stripped out before the bill passed. The pattern is not a coincidence. The people with the most to lose from tax reform are also the people with the most resources to fight it. Lobbying in the United States is a multi-billion-dollar industry. The financial sector is consistently among the top spenders. And the revolving door between Wall Street and Washington is well documented. This is not a conspiracy. It is an incentive structure. And incentive structures tend to produce predictable outcomes, the bigger picture. Here is where we need to pull back and look at the shape of the thing. Because the conversation usually gets framed as rich versus poor, left versus right, capitalism versus socialism. And that framing misses the actual argument. The actual argument is about what kind of economy you are building when you systematically reward capital over labor. When the person who owns the building pays a lower effective rate than the person who cleans it. Research from economists Emmanuel Saez and Gabriel Zuckman, both at UC Berkeley, found that in 2018, for the first time in American history, billionaires paid a lower effective total tax rate than working-class Americans. Not just on income. On total taxes, including sales taxes, payroll taxes, property taxes, everything. That has not happened since before the income tax was created in 1913. Their book, The Triumph of Injustice, laid out how this shift happened incrementally over decades. Not through one dramatic act, but through 1,000 small adjustments. Rate cuts here. A new carve-out there. A loophole expanded under one administration and never closed by the next. Each individual change seemed reasonable in isolation. Together, they constructed a fundamentally different system than the one that existed in 1960, when the top marginal income tax rate was 91%. 91%. That is not a typo. In the post-war boom, the era most Americans think of as the golden age of the middle class, the era of single-income households buying homes and sending kids to college, the richest Americans faced a 91% top marginal rate. And somehow the economy kept growing. Somehow companies kept getting built. Somehow rich people were still rich. The argument that low taxes on wealth are necessary for economic growth is, at minimum, contested by the historical record. The quiet irony. There is a particular irony buried in all of this. The complexity of the tax code is itself a barrier. The IRS tax code in the United States runs to roughly 4 million words. It is longer than the entire works of Shakespeare, Tolstoy, and the Bible combined. Most working Americans cannot navigate it alone. They pay someone to file a relatively simple return. The ultra-wealthy hire entire teams, tax attorneys, CPAs, estate planners, family office professionals, whose sole purpose is to minimize the tax bill. The more complex the code becomes, the more valuable those specialists are, and the more advantage flows to people who can afford to employ them. The complexity is not accidental. It is, in a sense, a feature. Every carve-out, every exception, every special provision was lobbied for by someone who intended to use it. And the people who lobbied for it had the resources to use it forever. The person who cannot afford a tax professional files a simple return and pays the standard rate. The system is, in a very practical sense, more expensive if you are poor. The unresolved question. So where does that leave us? We are not in 1913 anymore. We are in a world where private wealth can outscale the GDP of entire countries. Where a single individual can hold more financial power than most national governments. Where the mechanisms for accumulating that wealth have been not just permitted but actively coded into law. Some people look at this and see injustice. Some look at it and see the natural reward for risk-taking and innovation. Most people, if they are being honest, feel something more ambivalent, a low hum of recognition that the rules were not designed with them in mind. The question that does not have an easy answer is this. Is a system built on legal frameworks that produce radically unequal outcomes still a just system, simply because it follows its own rules? Buffett himself seems to think not. He has been saying publicly for decades that he should be paying more. He has called for higher taxes on the wealthy. He has endorsed the Buffett rule. He has pledged to give away most of his fortune. And he still pays a lower effective rate than his secretary. Because the rules have not changed. The rules do not change unless the people who write them have a reason to. And the people who benefit most from the current rules are exactly the people who have the most influence over the people who write them. That is not an accusation. That is just how power works. The question is whether enough people understand the system clearly enough to decide what they want to do about it. You have now been briefed.